Want to invest smart before 2025? Here are 10 solid choices from ultra-safe to high growth. You won't see any surprise cryptocurrency or meme stocks here, but these have stood the test of time and experts say are poised to keep paying off. Plus, I'll spill where the super rich are putting their money for some bonus insight. No. 1. High-yield savings accounts. Why it's good. Super safe, liquid, FDIC insured. You get notably higher interest than standard savings accounts without taking on much risk at all. Great for emergency funds, saving for a down payment, or short-term money goals. The catch, still relatively low returns, but that's the trade-off for peace of mind. The real world tip, currently you can score around a 4% AP. Some banks offer even more. Check out Ally Bank, Wealthfront, and Sophie for competitive rates. Number 2, certificates of deposit. Why they work. CDs or certificates of deposit offer fixed interest rates over set terms. Your money is locked in for the duration, but you'll earn a guaranteed return. They're FDIC insured, so you're protected. It's an ideal option if you have extra cash you do and need immediately and you want predictable returns. The catch, like savings accounts, they still have relatively low yields. However, you can find CDIS offering around 5% AP right now. So it may be worth considering. The real-world tip. Look into 6 to 12-month terms for more flexibility without locking up your cash for too long. Sites like NerdWallet and deposit accounts. Com can help you shop around for the best rates. No. 3. Government bonds. Why include them? Also known as Treasury securities, these are debt obligations issued by the U.S. government. They re extremely low risk since they re-backed by the full faith of the government and they pay a fixed amount of interest over time. If you're a conservative investor or want to balance riskier assets in your portfolio, government bonds are always a reliable choice. The catch, as of recording, the average yield on a 10-year Treasury note is just above 4%. That might not beat inflation, so you could see erosion in your purchasing power. The real-world tip. Consider Treasury inflation-protected securities tips, which adjust principal value based on inflation. That way, your returns can keep pace with rising prices. Number 4, corporate bonds. Why consider them? Corporate bonds offer higher yields than government bonds because they come with a bit more risk. When you lend money to a company by buying its bond, you're taking a chance on that company's ability to repay you. But if you invest in bonds from credit-worthy firms, the risk is relatively low. The bonds typically have maturities of 2 to 30 years and pay semi-annual interest payments. The catch. If the company that issued the bond faces financial difficulties, they may default on their payments, which could result in losses for you. The real-world tip. Look into investment-grade corporate bonds from companies with strong credit ratings. Sites like Fidelity and Charles Schwab let you buy and sell individual bonds or through bond funds for diversification. No. 5. Money market funds. Why use them? These are investment funds that buy super short-term debt from governments and corporations. Think of it like a basket of super safe, very short-term loans. It's a great option if you want better yields than a savings account, but still want easy access to your cash and minimal risk. The catch. While money market funds are very liquid and less risky than most investments, their returns still tend to lag behind stocks and other investments. The real-world tip, look for institutional money market funds, which tend to have higher yields than government money market funds. Vanguard, Schwab, and Fidelity all offer options. No. 6. Mutual funds. Why include them? Mutual funds pool money from multiple investors to invest in a diversified portfolio of assets like stocks, bonds, and other securities. They're managed by professionals who make investment decisions on behalf of the fund's investors. Great if you want to invest for the long term and don't have time to manage your own portfolio. The catch: mutual funds often charge fees, which can eat into your returns. The real-world tip: look for funds with low expense ratios, ideally under 1%. Target date funds are a popular option that adjust their asset allocation automatically as you approach retirement. No. 7. Index funds and exchange-traded funds. Why invest? Both index funds and ETFs offer broad exposure to the stock market at rock-bottom costs. They are essentially baskets of stocks that track an index like the S&P 500. Because they are so diversified, they typically have lower risk than individual stocks. And since they're passive investments, they generally have very low fees. The catch: like most stock-based investments, their returns aren't guaranteed and you could lose money. The real-world tip: ETFs like VU and IVV are great options to get started. They track the S&P 500 and have very low expense ratios. No. 8. Dividend stocks. Why pick them? Dividend stocks are shares of companies that pay regular dividends to their shareholders. Companies that consistently pay dividends tend to be well established and financially stable. They're a good option if you're looking for passive income and long-term growth. The catch: not all companies pay dividends, and those that do can cut or suspend them at any time. The real-world tip: look for companies with a history of paying dividends and strong earnings growth to boost both your income and your investment value over time. No. 9. Real estate. Why actionable? Real estate can be a great investment if you want to build wealth and generate income. The benefits are clear. Enjoy tax advantages, build equity, and hedge against inflation. You can start small by investing in a REIT, a type of investment fund that invests in real estate. Or you can go all in by buying a rental property directly. If you want to build equity and receive rental income, the catch: real estate can be illiquid, meaning it's not easily converted into cash. It also requires a lot of work and expertise to manage properties effectively. The real-world tip: consider investing in a REIT like VNQ or SCHD if you want to get into real estate without directly owning a property. Number 10. Alternative investments. Why explore? Alternatives are investments that don't fall into the traditional categories of stocks, bonds, or cash. Examples include private equity, venture capital, collectibles, and commodities. They can offer higher returns and exposure to unique growth areas such as housing shortages, AI infrastructure, and clean energy. The catch: alternative investments can be less regulated and more volatile than traditional investments. They can also be hard to value and sell quickly if you need to. The real-world tip: around 90% of the ultra-wealthy allocate between 20 and 60% of their portfolios to alternatives, according to JP Morgan Private Bank. Consider thematic funds that focus on specific trends like tech innovation or sustainable energy for more accessible exposure to alternatives. The bottom line: diversify. Even the richest folks spread their investments across multiple sectors. Don't put all your eggs in one basket. And remember, the best investments for you depend on your financial situation, goals, and risk tolerance. So take the time to figure out what works for you. Now drop your favorite investment in the comments below. I can't wait to see what you're banking on next. And if you found this video helpful, please hit the like button and subscribe for more videos like this. Thanks for tuning in.